Hi there, this is Tom Lee. I'm the Chief Investment Officer of Fundstrat Capital and the lead portfolio manager for Fundstrat's family of ETFs called GRNY Shots. This is our week update for the week of November 24th. Fundstrat has now expanded the GRNY Shots family to include two additional ETFs. The first one is GRNJ, Fundstrat GRNY Shots for US small mid-cap ETFs. Think of the letter J as junior. And basically, it is the small and mid-cap version of GRNY, which is large cap GRNYs. Or think of it as twinning. The second is GRNI, and that's Fundstrat's GRNY Shots large cap and income ETF. So basically, think of it as GRNY with income. As of November 21st, GRNY had total assets of 3.5 billion. GRNJ 55 million, and GRNI 15 million. As for performance over the past week, GRNY fell 2.76% compared to a 1% decline in the S&P 500 or underperformance of 175 basis points. GRNJ fell 1.28% over the past week compared to a 0.98% rise for the Russell 2500 or 238 basis points of underperformance. And GRNI fell 2.26% over the past week compared to a 1% decline in the S&P or underperformance of roughly 145 basis points. Well, what's happening here? Well, there's turbulence in the market now. And that's what's causing some underperformance of GRNY ETFs. But we believe the year-end rally is intact. So let's take a look. Since the October highs, the S&P 500 is down nearly 6% and down 3.5% for the month. That's pretty significant underperformance, and it feels terrible, especially given stocks had been up for 6 months in a row. But if you zoom out, you can see that this is the 7th correction of roughly anything over 3%. So, and it is the most severe correction, however, since the tariff wars. So the question is us being down 6% really changing the bigger picture? In my opinion, not really. I think we're still on track to have a year-end rally and the S&P reaching 7,000 to 7,300. And here's 5 reasons for this, okay? Number 1, the government shutdown ended. Keep in mind, this was the longest government shutdown in history. It was 43 days. There's a lot of disruption that comes from that, and you can imagine a lot of anxiety. The second is that the Fed is going to be cutting in December, even if they're cutting hawkishly. Now, you might say, didn't Powell kind of rule out a Fed cut? Well, take a look at Polymarket. It's been very good at predicting outcomes, and you can see that the latest Polymarket shows a 67% probability of a Fed cut in December. That's pretty good. Now, there's a 32% chance of no cut, so of course the market is debating between the two. But again, we lean towards the fact that the Fed will be cutting. The third is their seasonal strength. Now, the market's already shown its strong hand because it was up 6 months in a row from May to October. That's only happened 6 times in history. Here's the thing. In the 6 prior instances, the market gained 21% over those 6 months. And in 2025, we gained 23%. So it's a pretty strong market. But let's look at that November to December return. The median gain is 5.4%. In fact, it's probably arguably better than that because 5 of the 6 of these instances was a rally, whereas there was one decline, which was 1936. Now, remember, that was really in the aftermath of the Great Depression. So I'm not inclined to look at that as an example. In fact, if you look at the 2 most recent instances, even the most 3, markets were really strong into year-end. Okay, now the 4th reason I'm constructing the year-end is the markets are oversold. So we're going into a seasonally strong period while the markets are oversold. Here is the daily RSI. It fell to 35 on the S&P. And as you can see, that's the lowest reading all year, except during the tariff wars. Now, that wasn't a bad time to be buying stocks then. I think it's a pretty good time to be buying stocks now. And finally, investor sentiment's bearish. Now that's going to happen because the market's been grinding down for 3 weeks. But the latest AAII net bears less bulls shows there's a huge jump in the number of bears. That's the thing. When everyone's bearish in the midst of a market being oversold and now entering a seasonally strong period, I'd kind of lean to the fact that this is going to catch a lot of people by surprise. There's a short week this week because of the Thanksgiving holiday. And I'd say the most notable will be on Tuesday with the September core PPI. The reason we don't have CPI, though, is the US canceled the release of that report for October. They just didn't have the data available to actually calculate CPI for October. And it follows on the fact that they had to cancel the October jobs report for the exact same reason. They couldn't collect the data. And as for earnings, the only granny shots reporting this week is John Deere on Wednesday before the open. So let's go over granny stock individual performance. In the large cap GRNY and in the income GRNI, they have an identical portfolio. Here is the top 5 performers. Okay, Google, TJX, Deere, PNC, and Monster Beverage. Now, the bottom 5 performers did a lot worse than the top 5. That's why the ETF actually fell. You can see it's Palo Alto Networks, Palantir, Robinhood Strategy, and AMD. Now, these are all double-digit declines. Did the fundamentals change? No, but these are AI and strong year-to-date performers. And you know what? As the markets gets nervous, and it's down 6%, you're obviously going to see people selling their winners. Now, on the SMID side, here are the top 5 performers: Dycom, Western Alliance Bancorp, Installed Building Products, Lumentum, and East West Bancorp. The bottom 5 were Sanmina, Riot Platforms, Roblox, IonQ, and Bloom Energy. And again, those bottom 5 did a lot worse than the top 5, but it's really showing you the AI and strong year-to-date performers are seeing profit taking. And as far as themes go, the PMI's recovery theme outperformed, as did seasonality, and the large cap grannies easing financial conditions outperformed. Thanks for listening, and I'll speak to you soon. Happy Thanksgiving.